Welcome back. We're now going to look at interpreting financial statements. Financial statements are the language of business. You have to have a basic understanding of what financial statements mean, or you will always be clueless, like an Englishman in New York. No, that's not what I meant. That's an old Sting song. I meant like a Angelino in Iowa, maybe. So, I won't be teaching you all the details and nuances of accounting. For one, I don't truly understand them either, and the rules are always changing. So I'm going to try to teach you the most basic, important aspects and give you a principle for understanding that will be useful for a few more decades for your career and work life. I have one particular goal in mind. We want to figure out how companies are reporting the cash flows that we want to use in an NPV analysis. It ain't the earnings that you want, in any case. It turns out that this is not difficult, but it's a little bit tricky. For starters, companies report something different to the IRS than what they report to public investors. So we're going to start with the IRS numbers and only later go to the public financials. In the beginning, imagine you could see the IRS numbers. In reality, that's not really true. Those are secret, but they can be reconstructed. So, IRS rules. The IRS requires firms to deliver financial statements according to its own rules. These rules include their mandated depreciation schedules. We'll talk about the public financials a little later. They very often have different depreciation schedules. In a sense, the IRS financials are more real than the public ones. The taxes that are computed from them are real and have to be paid, whereas the taxes on the public income statements that you usually read on Yahoo or anywhere else are really bogus. So we're going to start with creating an IRS income statement and an IRS cash flow statement. And unlike normal projects where this goes on for many, many years, because we don't want to be here forever, we're just going to presume we have a 3-year project. And there's going to be $250 capital expense in year 1. You have to build the factory, the West Wing, get started on it. Then you have another $50 capital expense in year 2. Your net revenues, your earnings before interest, taxes, depreciation, and amortization are going to be $200 in year 1, $400 in year 2, and $200 in year 3. Your cost of capital is going to be 15% per year, although we're not going to use this until after we have the cash flows. That is only when we want to discount them. We're going to assume that we have a corporate tax rate of 40% per year. We're also going to assume that we're going to have to borrow $200 in order to get started. So in year 1, I'm going to assume that I have the money, but I already have to pay interest. Finally, I'm going to assume that the IRS allows depreciation over 2 years linear. Now, the usual schedules for various types of assets are 5 years, 7 years, or 10 years. And that depends on the asset type. And more than that, it depends on whatever Congress in a particular moment in time wants to give advantageous treatment to. So sometimes they want to allow research and development expenditures to be depreciated over 1 year, that is expensed immediately, or over 3 years. It can happen all the time. But again, we're too lazy to deal with 5 columns, so we're just going to sketch the world with a 2-year depreciation schedule. It will work the same way with more years. We're going to be a little bit loose with the debt, principal, receipts, and interest payment timings, but we're also going to be loose with intra-year timing. This is really for illustration's sake. So our capital expenditures are going to create sales already in the first year. And just like interest is paid in the year that the debt principal is received. So we have to start with constructing an income statement. Make sure you try. This should take you a few minutes paging forth and back with those previous slides that we have that gave you all the numbers that you need. Try and produce a basic income statement. The first part that I want you to do is think about what are the important rows, the basic rows in an income statement that we can populate based on all the information that was there before. So a typical income statement starts with sales, cost of goods sold, selling, general, and administrative expenses. And we've lumped that all into one number, so it's just our overall number. After that, we want to subtract out depreciation. That gives us operating income. Then we want to subtract out interest. That gives us earnings before taxes. Then we want to subtract out taxes, and that will give us net income. So that is the basic framework of an income statement. What I want you to do now is fill in year one in this income statement that you saw in the previous slide.
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, here is your income statement. So our sales, net sales, in year one were $200. Our depreciation is $125. We have 2 years depreciation. We had $250 of capital expenses. So 250 divided by 2 is 125. Subtracting the depreciation gives us the operating income, which is $75. The interest that we have to pay was $20. We borrowed $200. The earnings before taxes is therefore $55. Then we calculate the tax according to our 40% tax rate. That gives us the net income. Take a look at that. Make sure you have that right. Now, can you fill in year two? This was where we were.
Please pause this video now, answer the question on a piece of paper, and then continue.
Same principle as before. We've got $400 now in sales. For depreciation, we still get another $125 from year one, which we haven't used yet. That'll be the last one for that. But then because we're spending $50, we get an extra $25 of depreciation. And just go down all the numbers and out will come a net income of $138. Now, I hope you got the principle of this, because now I really want you to do year three.
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, so this is our income statement. 200, 400, 200. Looking at the last line, the net income 33, 138, and 93. Now, in finance, we sort of consider a project like a black box, and it has cash inflows and cash outflows. And those are provided by the financiers. And this is not just the equity, but it's both debt and equity. So the debt gives money, the equity gives money, while the equity has to provide the rest of the money, and then both debt and equity get cash flows back out. For our purposes, the interest payments are a flow that goes back to financiers too, just like dividend payments. From an accounting perspective, that's not exactly the way they look at it. They consider them not like money that is being paid back, but just more like money that evaporates. It's like grease. So for us, it's a return of capital to financiers. For them, they are costs of operating. So we have to take into account that money paid out in interest is money returned to capital providers. If you own just the equity, you borrow money from somebody else, then you get the cash inflow from the creditors upfront. This is a cash flow to you. But then you have to pay the interest to your creditors later. In this case, you must count both. So the total project cash flows can be paid out to debt and equity holders combined. Imagine you provide both debt and equity and you get dividends and interest payment. You've provided all the capital, you get all the return from the capital. And we subtract interest only ever if you add the money that you got from the loan. So for the project, all cash flows goes to both owners. For the equity, we receive as inflow the credit principal, the money that we borrowed, but then we have to pay back the interest and the principal. So we have two kinds of cash flows, project cash flows and equity cash flows. I have to give you a short warning. This is not the as if unlevered project cash flows that are going to appear later. If that means nothing to you, please ignore this. Now, which of the components of the financial statements are real when calculating cash flows? And the choices are the sales number, the depreciation number, the interest number, the tax number, the debt issue number, the CapEx, and if you want, the accumulated depreciation, how much it adds every time. And what I mean by real is what are the numbers that really happen at that moment in time, and what are things that we've manipulated for accounting purposes. Think about this. In each one, write either real or fake.
Please pause this video now, answer the question on a piece of paper, and then continue.
So, sales, real. Depreciation, no. Depreciation was something we made up. The actual amount that we had to pay out were the capital expenditures. They're much further down. So depreciation, no. Capital expenditure, yes. The interest matters to us as equity because then it's really something that we need to pay back, but not to the financiers in total, not to the people providing capital. The tax is real. The debt issue, together with the interest, comes to equity, not to the financiers overall, because overall they have to provide it. And similarly, the accumulated depreciation is actually just a funny number calculated from another funny number. Using this qualification, what are the project, the firm's cash flows?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, so here are the actual real cash flows. We get the sales in year one, $200. We pay the tax, this is real money, $22, and we pay for the capital expenditures. So in the first year, my real cash flow is a negative 72. Do this for the other 2 years, and you get $258 and $138. So what is the project firm net present value at a cost of capital of 15%?
Please pause this video now, answer the question on a piece of paper, and then continue.
Oh, that's easy. We just take those three numbers and appropriately discount them according to the net present value formula. So the net present value of the project seems to be $257. The cash flow statement will repeat the depreciation on the income statement, plus it's going to contain the debt issue and the capital expenditures that you will need later on for other calculations. So if we looked at a cash flow statement, it would also tell us, in addition to other things, that we have the debt issue, plus 200 year one, minus 200 principal repayment year three. We have the capital expenditures. And finally, I have the depreciation, which we had as 125, followed by 150, followed by 25. There's a little nerd note at the bottom. There's a little nerd note at the bottom. That's basically because my statement here is not fully correct. It turns out some of the depreciation that we've just put in here is rolled into SG&A and COGS on the income statement. So we really need the one in the cash flow statement, not the one on the income statement. That turns out to be one of those accounting nuances. We're just going to pretend they're the same numbers. In the real world, when you have to get this out, you pick off the depreciation from the cash flow statement, not from the income statement. Using your classification of what's real and what's fake, what are the equity cash flows?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the equity cash flows are just like the project cash flows, except that we get the money from the creditors, but we also have to pay out the money to the creditors. So in the first year, we get $200 from the creditors, but we have to pay $20 in interest. So we're going to end up with $108. And this, by the way, is where I've been somewhat loose, because the $200 really is presumably occurring at the beginning of the year. The $20 is paid later in the year. So we have different costs. We have different discount rates, costs of capital for those things. We're not going to distinguish between them for this particular exercise. We just leave it as it is. In year 2, we basically just pay $20 in interest. And in year 3, we have to repay the principal and the interest. So my new cash flows are going to be $108, $238, and minus $82. What is the equity-only net present value if the cost of capital is 20%?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, we just take those 3 cash flows, discount it with 1.2, and out comes $249. Now what we want to do is a little bit tricky. We want to calculate the project and equity cash flows, reverse engineering them from the financials. So what do we see on the financials? Well, we see capital expenditures. It's going to be on the cash flow statement. We see the debt issuing. That's going to be on the cash flow statement. We see depreciation. Those should be on both the income and the cash flow statement. In the real world, it's only the one from the cash flow statement that you can use. We see operating incomes. We see earnings before taxes. We see income tax, interest, net income, and sales. So how do I get the numbers that I want? There are many ways to get them. One is cash flow is net sales minus tax minus capital expenditures. This is what we just calculated before. This is exactly the numbers that we took and added, subtracted. Another thing is that we can start with net income, the thing at the bottom of the income statement, add back depreciation, subtract out capital expenditure, sort of what we spend for the factory. We take the funny numbers from the accountants and we undo their calculation. So we make it appropriate timing, and then we add back interest because, of course, the people that provide the interest is us. This is a return of capital. Many people have memorized the first 2 terms of the second version and use it as a shortcut. So they will just say, oh, cash flows, net income plus depreciation. But that's really a terrible idea because depreciation ultimately comes from capital expenditures. So let's confirm the 2 variants for the project cash flows for year 2. Take those formulas, calculate them.
Please pause this video now, answer the question on a piece of paper, and then continue.
So here's the year 2 numbers. Cash flows is net sales minus tax minus capital expenditures. We calculated that just before. Here's the second version. We start with net income of 138. We add back depreciation, subtract out capital expenditures, add the interest. We get exactly the same number. Now, could we have just discounted net income? Would that have been close enough to the cash flows that we use?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, if we had discounted net income, what we would have gotten is $223. That is far from the correct $257 calculated earlier. So discounting net income is a no-go for cash flow analysis. Would it make sense, perhaps, to discount EBITDA? That is, you just say take sales minus COGS minus SG&A. Would that be giving us an okay number?
Please pause this video now, answer the question on a piece of paper, and then continue.
Are you nuts? Why would you want to discount near sales? This ignores all tax payments and it ignores all the costs for the factory. It's like the factory is a free gift. It fell like manna from heaven. So this is definitely not what we would want to do. What about discounting net income plus depreciation?
Please pause this video now, answer the question on a piece of paper, and then continue.
In that case, you really should get your head examined. You'd be super nuts. Now, not only do you not subtract out the fact that you had a capital expense to build the factory, but you're adding back depreciation as if that was money you got coming like manna from heaven. You didn't even have to build the factory paid you. So not only was it free, you got extra money from not having to build it. So at least EBITDA alone did not add depreciation. The idea of net income plus depreciation, which many people have in their head, is just super insane. Now, this is already something that I mentioned. Depreciation should come from the cash flow statement, not from the income statement. It's a fairly common new student mistake. I actually made that one for a long time myself. And the reason why the two are different is because some of the depreciation of what we really need in the cash flow statement has been rolled into SG&A and COGS on the income statement in a real financial statement. Now we're going to make the world a little bit more complex. We're going to say that all we see are the public financials, not the IRS financials, but the project itself, all the cash flows, stay exactly the same. We're not doing anything different, just the reporting has changed. So, first question is, what are taxes payable?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, taxes payable are an item that's a part of working capital. And what that represents is just the fact that you don't immediately every month or every year pay your income taxes. You can wait until April 15th of the next year in order to pay your taxes. Well, April 15th is tax days for individuals, what the equivalent is for corporations. So that's the same, but that's actually not the big item that we have to be concerned about here. What is deferred tax? That's more interesting.
Please pause this video now, answer the question on a piece of paper, and then continue.
So, deferred tax accounts for the fact that the IRS has a different depreciation schedule. So, what the accountants are doing is they set aside the tax payments that are different from what they really have to pay. So, I have one presumed depreciation, which is the real depreciation, how long it takes for the building to run down, how long I can drive the car. Then I have another one that the IRS tells me I should be using, that may be 3 years, and cars last for longer than 3 years. And I have to code somewhere on the public financials where this difference is. And that turns out to be coded on the balance sheet. And that one is a long-term concern. So we again work with a simplified example. The IRS is going to presumably still have our 2-year depreciation schedule, but now GAAP, the general accepted accounting principles, which I'm going to call the stuff that the public financial statements report, say they require 3-year depreciation. So we have a car that really lasts for 3 years, then it falls apart, but the IRS says we can depreciate it over 2 years. So in this particular case with our factory, the IRS said we can depreciate our factory by $125 per year, but GAAP, the public number, said only $83 per year. So we had lower depreciation on the public financial statements. Therefore, we had higher net income. So if I calculate the tax based on 40% of my GAAP income, it's going to state that I actually paid more in taxes on my public financials than I actually paid in real life. And that's what we have to adjust for here. we have to adjust for this $42 per year difference to be recorded. This is done on the balance sheet. It accumulates the relative tax difference. So recall our capital expenditures and, most important, our IRS depreciation. We could depreciate $125 in year one, $150 in year two, and $25 in year three. What would be our GAAP depreciation? Same accounting principles, but instead of 3 years, we have to use 4 years now.
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, so first year, we have $250, but we have to divide it in 3 now. So it's $83. The following year, I get again $83, and now this time also in the third year, it is $83. But in addition, I get the $50 that I've spent in the second year divided by 3. So I have $100 that I depreciate, another $100 in year 3, and then $17 in year 4. How would the publicly reported GAAP financials look like?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, here's how the public financials would look like. We would have to use the depreciation that GAAP allows, which would be 83, 100, 117. Going down all the statements, we calculate the tax at the normal 40% as we had before. Now our net income looks different. The net income on the public financials, not on the IRS financials, is $58 in year 1, $168 in year 2, $48 year 3, and then in year 4, I actually have a loss of $10. So I now need 4 years rather than 3 years on my income statement. How much have we really paid in income taxes versus how much have we publicly reported in taxes? Compare the two.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the IRS depreciation was 125, 150, 25, nothing. The GAAP depreciation was 83, 100, 117. The IRS true amount that we actually had to pay was $22 in year 1, then $92 in year 2, $62 in year 3, and nothing in year 4. GAAP, however, claimed that we had paid $39, then $112, then $32, and then that we got $7 back. So GAAP claimed that we paid more in the beginning and less towards the end. Where on the public financials would you find IRS tax payments?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, so first let's do a crib sheet here. So we claimed that we had $39 paid in GAAP. By the IRS true number, it was $22. So my current deferred tax in year 1 is the difference between those two, $17. Do the same thing the following year, 112 minus 92, you get plus 20, then you get minus 30, then you get minus 7. On the balance sheet, you are not being told the current deferred tax in each year. What you get is the accumulated deferred tax. So it begins with the $17 in year 1. There was nothing before. But then what it does is it takes the previous accumulated number and adds it to the next number. So 17 plus 20 is going to be 37. Then I'm going to subtract out $30. Then I'm going to subtract out $7. This is what you actually see on public financial statements. On the balance sheet, the accumulated deferred tax. Now, project and economic cash flows have not changed at all. The only thing that has changed is some smoke. You now see only the public financials, not the IRS financials. But we now need a formula. we now need a formula to reverse engineer the same numbers that we had before, which was minus 72 plus 258 plus 138. And here is a reminder, this was our income statement. And now on the balance sheet, we have the accumulated deferred tax. So you want a formula now that allows you to reverse engineer the true cash flows from the public financials. And for your convenience, I've just put up the cash flow calculations here as before. Net interest plus depreciation plus negative capital expenditures. This is the part one, the public income statement that you can see. And what you want to come out are the cash flows. And because the project is still the same, of course, you want this to be the minus 72, 258, 138. You fill in for me, please. What should be where the question marks are?
Please pause this video now, answer the question on a piece of paper, and then continue.
Okay, so you could do this really simple by taking the cash flows at the bottom and the part one numbers and just calculating out the difference. Or you can do what we really do, because we usually don't have the final cash flows immediately. We figure out what the change in deferred tax was. And we just calculated the change in deferred tax. So it was $17 the first year. Then we want to take the deferred tax accumulated, which was 37, and subtract off what we had in year one. That gives us $20. That gives us then the difference in the second year that we want. And we do the same thing in year two and year three. So, but I hope you understand the logic now, because what we are doing here is just trying to undo the overstatement of taxes on the public financial statements. And in order to do that, we need to undo the accumulated deferred tax that is reported to us on the balance sheet. With the true IRS financials, we were done with part one. So here is the number, minus 72. With the public financials, we just had to work with the changes in deferred taxes. And by the time you do this, you get the same number. Now we're going to make the world even more complex. We're going to assume that our customers are not paying us immediately. They're not going to be deadbeats. They're always paying, but delayed. Means the project has changed. The economics now are quite different. We get real money later. So by the net present value calculations, we're not going to be as well off as we were before. And our accounts receivables have to reflect that we get half now and half later. So customers pay half what they owe immediately, half what they owe the following year. Does the new scenario change the project net present value?
Please pause this video now, answer the question on a piece of paper, and then continue.
Yes, the cash inflow timings are all different. Thus, the net present value will be different too. In the real world, we'd also have to take account of deadbeats. We don't need to do that here. This is just for principle. So now, what are your true cash flows going to be?
Please pause this video now, answer the question on a piece of paper, and then continue.
So the first year, we're going to get $100 less than we did before. $200 less from the second year customers, but we get the $100 back from the first year guys that hadn't paid them yet. We're going to go get those in the second year. So if you look at this comparison that I've put up here, the reported sales were 200, 400, 200, and then nothing. But if you look at the real cash in, well, first year we only got 100. Second year, we got 100 from the first year guys and 200 from the second year guys. Year three, then we get the rest from the year two guys and some from the year three guys. And then we get some more money from the year three guys in year four. So the revised cash flow formula now needs to come to the following. Before, we had a loss of $72. Now we have a negative cash flow of minus $172. In the second year, I still have $100 less, so I'm going to get only $158. The third year, I'm going to get extra money now, so I'm going to have $238, and in the final year, I'm going to get $100. How does our public income statement look like now?
Please pause this video now, answer the question on a piece of paper, and then continue.
Still the same. Nothing has changed. The accountants will book the sales because we are certain that we're going to get the money in the future. The sales have occurred at the moment, even if we only get paid later on. What has changed then? So the income statement hasn't changed. What will change on the public financials?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, what I need to do is I need to take the change in working capital, that is the negative of the accounts receivable. And that's the second to last number on the financial statement, on the cash flow that I put up for you here. So subtracts out 100 in the first year, subtracts out 100 the second year, then plus 100 and plus 100 again. And that gives you the correct cash flows. What else is in working capital?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, there are such things as cash management, accounts payables, inventories, plus many other little items, and that depends on the kind of firms that we're dealing with. It's not all the same for every firm. Why do we work with changes in working capital and not working capital itself?
Please pause this video now, answer the question on a piece of paper, and then continue.
Because this is the balance sheet which records stock quantities, and we are interested in the flows, that is, how things change from year to year. So if you always have $100 outstanding as accounts receivables, in this case, no extra money has to come in and out for that. So flows are typically related to changes in stock. There's another big item in many accounting statements called investment in goodwill. What is that?
Please pause this video now, answer the question on a piece of paper, and then continue.
That's the accountant's idea of a joke. They're playing a joke on us. They are using name puns. What it really is a way to depreciate assets from mergers and acquisition activity. So the following now is a common, more complete cash flow formula. We start with net income before taxes. We add interest expense, gives us EBIT, minus corporate income tax, net operating profit, plus changes in deferred taxes, plus depreciation, gives us gross cash flows. We subtract out capital expenditures, changes in working capital, investment in goodwill, and all sorts of other miscellaneous items. We get free cash flow from operations. And in the real world, then we have a whole set of other statements that are related to acquisitions, divestitures, short-term investments, things like currencies, miscellaneous investment. We have net issuance of debt and interest expense. It's all in there. So look at any public firm's cash flow statement, and you will get something that looks very much like what we have done here right now. So this is an informal assignment. Just go to Yahoo Finance and look at a cash flow statement. See if you can recognize all the things that we discussed so far. Importantly, you should now understand the connection between the income statement, the balance sheet, and the cash flow statement that is relevant to our own needs, our finance need. So you should be able, in principle, to deduce the cash flows from the income statement and the balance sheet and construct a cash flow statement. Almost, except some items like depreciation are really only broken out correctly on the cash flow statement. So it's usually best and easiest to obtain your estimate of the cash flows directly from the cash flow statement. The only big difference that we have relates to the fact of how accountants see interest payments and how finance sees interest payments. The accountants see this as the cost of grease to run the machinery. It's something that evaporates. In finance, we view it as a return to capital providers. So we just need to fix up this one little item. So the cash flow to the project is going to be the cash flow from operating plus the cash flow from investing plus the interest expense. And then the cash flow to the equity is the cash flow to the project. Here we subtract out the interest expense again and add the net debt issue. So the last two items are adjusting for the fact that somebody else is the capital provider for the debt. Now I'm going to switch gear a little bit. So we look at the balance sheet of a publicly traded company. What is it that we actually can believe on it? What is more believable? What is less believable?
Please pause this video now, answer the question on a piece of paper, and then continue.
So things on the balance sheet are better when they're very short-term, things like cash. That's a very good number. Usually that's almost exactly on the money. Debt is somewhat okay. But equity, which is this very long amorphous thing, that's actually almost unbelievable. That's a funny number. And in fact, it's made up so that it equalizes the left side and the right side of the balance sheet. In many ways, BS is the right abbreviation for balance sheet. There's a lot of BS on balance sheets. Now, how, as an accountant, would you actually manipulate your financials? Could you over-report earnings? Could you over-report cash flows? How would you try to detect over-reporting by the management if you were an external analyst? So some of the manipulative abilities relate to a number of assumptions that you have to make. So how many products will your customers return? Well, this is something that the accountants have to guess. How much debt will be repaid to you if you sell a product on credit, for example? How much of your inventory will spoil? How long will your equipment last? Is it an expense like maintenance at one time, or is it more an acquisition? Should it be depreciated over many periods? So there is this discretion, and we should talk about those in class for a little bit. But suffice it to say, these are things that allow you to manipulate both earnings and cash flows. Earnings a lot easier than cash flows. The US has some of the highest quality financial statements in the world. It also has good legal enforcement. There's actually countries that have even more high quality rules, but they never enforce them. So they're irrelevant. They're on the book. And when the United States comes to complain about why it is that your financial statements are so bad, they say, oh, but look, our financial statements are so much better than yours because we require this, this, and the other. It's just that nobody ever enforces it. The GAAP rules deliberately reduce discretion, but even the limited discretion in GAAP is still enough to allow firms to change their financial statements. And distort is perhaps the wrong word here, because maybe what they're doing is making them more accurate rather than more inaccurate, because a lot of those things really do require judgment. And by choosing your rules, by choosing how conservative you are, you can actually be more accurate rather than less accurate. So many times, to assess the true value better, you need more discretion. That makes the financials less reliable. Economics, unfortunately, doesn't play by the rules of the financial accounting standard boards. Economics is not formulaic. It requires economic reasoning, and that's the opposite of just a mechanical rule. If it was just a mechanical rule, we wouldn't need managers. We need some discretion. We need some understanding of the underlying business beyond rules. So here's an example. The accountants consider a skyscraper built in New York in the 1950s to be worth nothing. Why? Because it has long since been depreciated. Buildings usually depreciate over 30 years. But that's, of course, nonsense. Skyscrapers in New York are worth a huge amount of money. C'est la vie. That's life. So that's it for this video, for Chapter 14, and for our finance take on the accounting domain. In the next chapter, we look at a method that avoids all this net present value and CAPM-P. Can such a method ever be any good? You may be surprised. See you soon. Bis bald. Can I tell you an accounting joke?
It's hardly material.
You took the words right out of my mouth.
That's not material.
Okay, what's the IRS agent's spirit animal?
What?
A vulture.